Hey everyone, and welcome to today's Explainer. So, if you're sitting here in this Intro to Business class, you probably have a couple of major goals in mind. First, you want to understand how businesses actually operate in the real world, right? And second, let's just be honest, you want to know how to build your own personal wealth over time. Well, you are in exactly the right place. Today, we're going to entirely demystify finance and securities markets. We'll explore how massive companies raise the millions or even billions they need to grow, and how you can use those exact same markets to make your money work for you. Let's get into it. I want to kick things off with this iconic piece of wisdom from Warren Buffett. He said, "The stock market is a device for transferring money from the impatient to the patient." It's brilliant, right? Because it perfectly captures the fundamental purpose of financial markets. At their core, these markets exist to move capital from those who have it, the savers, to those who can actually use it to build things. They literally turn savings into growth. And if you have that patience Buffett is talking about, they turn time into wealth. Here's a quick look at our roadmap for today. We'll start with why finance matters, then look at raising capital, take a tour inside the securities markets, examine risk, return, and some modern trends, and finally wrap up with your personal investing playbook. It's a journey from the corporate boardroom straight to your wallet. All right, let's jump straight into Module 1, Why Finance Matters. We're moving from accounting to action. As business students, you've probably spent plenty of time staring at balance sheets. That's accounting. It's the scorecard that tells you exactly where a business stands right now. Finance, on the other hand, is the action. It's the playbook for what you actually do next, and it rests on four main pillars. First up is capital allocation. This is deciding which new products or company acquisitions to actually fund and which ones to walk away from. Second is capital structure, which means finding the perfect mix of debt and equity so you don't overleverage your company. Third, you've got risk management, basically hedging against market shocks or wild interest rate spikes. And finally, value creation. This is all about translating your brilliant business strategy into actual long-term returns for your shareholders. Moving right along to Module 2, Raising Capital. It's the classic choice between debt and equity. Whenever a business needs money to grow, there are essentially two main doors they can walk through. Door number one is debt financing. Think of this as the borrowing to grow mindset. You borrow money from banks or bondholders, and you promise to pay it back with fixed interest. The huge upside, you keep total control of your company. The downside, you absolutely have to make those payments no matter how badly the business might be struggling. Then we have door number two, equity financing. This means selling a piece of your company to investors for cash. The major benefit here is that there's zero repayment required. If the company hits a rough patch, you don't owe those investors a fixed monthly check. But here's the catch. You are giving up a permanent share of your future profits, plus a vote in how the business is run, forever. Before we go deeper into debt and equity, I have to mention a secret third door, internal financing. Simply reinvesting your retained earnings, basically your past profits, is fundamentally the absolute cheapest capital you will ever raise. There are no pitches to investors, no interest payments to banks. It's great. However, it's totally limited by how profitable you've already been. That's exactly why fast-growing companies almost always have to look outside for funding. So how do chief financial officers actually make this choice? They use a decision matrix just like this. To put this in perspective, let's look at the cost and risk. With debt, the interest payments are actually tax deductible, which significantly lowers your effective cost. That's exactly why a massive cash-rich company like Apple still issued $5.2 billion in bonds back in 2023 at around a 4.5% interest rate. It was just incredibly cheap money to fund their stock buybacks. But miss a payment, and you're looking at bankruptcy. Now, on the flip side, consider equity. When Reddit needed cash to grow in 2024, they did an IPO, an initial public offering. They raised $748 million at a $6.4 billion valuation. They didn't take on any debt risk, but the founders and early investors had to heavily dilute their ownership. In fact, by the time a successful startup reaches a late funding stage, founders often own less than 20% of their own company. Wild, right? Okay, on to Module 3, Inside the Securities Markets. This is where stocks and bonds actually change hands. It is absolutely vital to understand the difference between primary and secondary markets. The primary market is where brand new securities are first sold. So when Reddit did that IPO, they sold shares in the primary market, and that $748 million in cash flowed straight into Reddit's bank account. But the secondary market, that's where existing securities trade between investors. If you go buy a share of Apple today, Apple doesn't actually get your money, another investor does. But here is the real kicker. The secondary market is what makes the primary market work. Without the liquidity of the secondary market, knowing you can easily sell your shares pretty much whenever you want, nobody would ever risk buying them in the primary market to begin with. Have you ever wondered what actually happens when you hit buy on your brokerage app? It's a fascinating millisecond-long journey. Step 1, you tap buy on your phone. Step 2, in a fraction of a second, your broker routes that order to an exchange, like the NYSE or NASDAQ. Step 3, the exchange's matching engine finds a seller at the best available price and executes the trade instantly. Step 4, the trade is cleared and settled by a central clearinghouse. The cash and shares officially change hands at what's called T+1, meaning exactly 1 business day after the trade. And just like that, boom, you are officially a part owner of a public corporation. Next up, Module 4, Risk, Return, and Trends. Basically, the rules of the game. If you're going to play in these markets, you absolutely need to know the rules. And the golden rule of finance is this: there is no such thing as a high return without high risk. If an investment promises you a massive payout with zero risk, you are either misreading the risk, or worse, you're being scammed. As an investor, you face a few very real flavors of danger. First up is market risk, the broad swings of the entire economy. I mean, remember when the S&P 500 fell 34% in just 33 days back in March of 2020? That's market risk. Then there's credit risk, which is the chance a borrower just outright defaults on a bond. There's inflation risk, which is kind of the quiet thief. Just look at the last few years. $100 from 2020 only buys about $82 worth of goods today because inflation quietly ate 20% of your purchasing power. And finally, liquidity and concentration risk. This is like having your entire retirement tied up in a single company's stock and being totally unable to sell when things go south. Now, while those types of risks are constant, the markets themselves are shifting incredibly fast. Just looking impartially at modern market data, we're seeing some staggering moves. Take this number, for example, $60 billion. That is the massive amount of capital inflows into Bitcoin exchange-traded funds, or ETFs, during their very first year after being approved in 2024. These ETFs act like a basket of assets you can trade easily on the stock market. Regardless of anyone's personal opinions on the asset itself, digital currencies have now firmly transitioned into a regulated, multi-billion-dollar asset class that both institutional and retail investors are heavily engaging with. And speaking of massive global shifts, how about $30 trillion? As of 2024, that is the sheer scale of capital invested globally using ESG criteria. That stands for environmental, social, and governance factors. So investors aren't just looking at the accounting numbers anymore. A massive portion of the market is actually allocating capital based on how sustainably and ethically a business operates. So who, or honestly what, is doing all this trading? Well, artificial intelligence and algorithms now execute over 70% of all U.S. equity volume. Generative AI is completely powering market research and portfolio analytics. Add to this the fact that zero-commission fintech platforms have brought in over 30 million brand new retail accounts since 2019, and it's super clear. The 2020s look absolutely nothing like the 2000s. The old barriers to entry are practically gone, and the speed of the market is entirely governed by code. Finally, let's hit Module 5, your personal investing playbook. We're talking about building your wealth over decades. Okay, so the markets are fast, complex, and full of risks. How do you, as a student about to step into your career, actually navigate this? Listen closely. When it comes to personal wealth, boring beats brilliant almost every single time. You do not need to be some Wall Street hotshot picking individual stocks to build incredible wealth. Here's your starter playbook. Number 1, index funds first. Low-cost index funds that own thousands of stocks for tiny fees historically beat 80% of active fund managers over a 20-year span. Number 2, maximize tax-advantaged accounts. If your future employer offers a 401k match, take it. That is literally free money. Then look into a Roth IRA where your investments grow completely tax-free. Number 3, diversify globally. It's been called the only free lunch in finance. Spreading your bets reduces your risk. And finally, dollar cost average. Just invest a set amount out of every single paycheck. It totally removes the emotion of trying to time the market, and you automatically buy more shares when the market dips. I want to wrap up today's explainer with a little thought experiment for you. Imagine you had $10,000 right now and a 30-year horizon until you needed to spend it. How would you invest it? And critically, how would your answer completely change if you needed that same money to buy a house in just 3 years? Think about the risk-return trade-offs we just talked about, the inflation eating your cash, and the volatility of the equity markets. Applying everything you've learned today to your own timeline is the real first step in your financial journey. Thanks so much for joining me for this deep dive, and I'll catch you next time.